Hey guys, are you having a hard time getting people to tell you how much your closing costs will be? They might be dodging because it's complex. I'm going to explain it using a loan estimate form that many banks use that look like this. As you can see, there's a lot of different parts, so sit down, we're going to go through them one by one. This is called a loan estimate form. Many banks use a form like this or one that looks like this because the government actually regulates these mortgage companies on how they should disclose the cost of the loan to you. Let's start with Section A, Origination Charges. In this section are the money that the bank makes for making this loan available to you. And they'll break it down by application fee, origination fee, all these fees that the bank gets to keep. Now, when you are comparing different lenders for their costs, this is the section that matters the most. For the purpose of comparing lender costs, make sure you ask the lender not to include any points. What are points? Well, that's another video. But if you want to compare banks on apples to apples, make sure that there's no point cost here, and then you can compare banks on their annual percentage rate, or APR. APR is your annual cost of having this loan, including the interest. The closer your APR rate is to the advertised interest rate, the lower the cost of the loan. Now, Part B, services you cannot shop for, are fees that the bank will have to pay to third parties for making this loan happen. They pass these fees on to you. You don't get a say in who they work with. That's why these are services you cannot shop for. Now, Part C is labeled services you can shop for, which is not a lie, but it's not really true for the buyer. The reason is it's the seller who usually chooses the title company. Because when the seller decides to put his house on sale, he already at that time has to decide who will handle this transaction. Next, we have other escrow costs. Like Section E, taxes and other government fees are determined by your local government. This is going to be the same regardless of who the title company or the lender is. Next, there are prepaids. These are things like homeowner's insurance, mortgage insurance, and property tax that you eventually will need to pay for anyways, but lenders usually like you to pay some of it up front. Some lenders require 2 months, others require an entire year's worth. Again, these are fees that you will eventually need to pay for anyways. What differs between lenders is how much of it they want you to pay up front. Next, in Section G, you'll notice that the line items look exactly the same as the section on prepaids. So why do you need to pay for it again here? Your first mortgage payment is usually not due until 1 month after the month of your closing. So if you close on January 15th, your first mortgage payment is not due until March 1st. In Section G is how much you owe from the time of closing until the time of your first mortgage payment. Section H are other items that you may choose to pay for, such as this example here shows, the owner's title policy. Now you may be going, wait, isn't that what was paid for in Section C, title insurance? No, Section C is title insurance to cover the lender. You are actually buying insurance for the lender in Section C. Lenders make this a requirement for lending you this money. Section H is if you want to buy title insurance to cover it yourself. What exactly is title insurance and do you need it? Well, that's another video. So that's the breakdown of all that you're paying for at closing. The rest of this form are just summaries. So Section I is sections E, F, G, and H summed together, and Section J is A, B, C, E, F, G, H summed together. As you can see in this example, your total closing cost is $8,513 minus $750 that the lender is giving you in credit. And so the total closing cost then is $7,763. Now that you have an idea of what all needs to be paid for at closing, let's go back and review why it's hard for people to tell you how much closing costs will be for you before you find a house. As you now can realize, the only fee that the lender has control over is in Section A. The house that you want to buy, its cost and location will determine things like appraisal fee, whether there's flood determination fee, how much the title insurance will be, how much is the local government fee, homeowner's insurance, property tax. These are all dependent on the specific house. And mortgage insurance depends on your credit and how much down payment you're putting down. And so there are a lot of different pieces that contribute to why it's hard to give you an estimated closing cost when you're just starting out. Once you are under contract for a house though, give the same house information to multiple lenders and compare their charges across these items to find one that is the best fit for you. Remember, the best lender is not only the one with the least cost. Also remember to compare lenders on their communication, their timeliness, and their willingness to answer your questions. If this information seems like a lot, it's okay because it is. The beauty of a video is that you can play this over as many times as you want until you get it. So take it slowly so that you understand what you're paying for. I hope this is helpful to you. If it is, please give me a thumbs up on YouTube. Also, please subscribe to my channel. That helps me out a lot. Thank you.